Okay, let's be real. You can't escape it, right? Every single headline, every market update, it seems like it's just screaming about the next big AI stock. It's got this total frenzy feeling, like a digital gold rush where fortunes are supposedly being made overnight. But whenever you see this much hype, you have to stop and ask yourself, what's really going on beneath the surface?
So let's just ground ourselves in a bit of reality for a second. According to the asset management firm GMO, what we're all watching isn't just a little market enthusiasm. They're calling it an extreme bubble. And if history has taught us anything about bubbles, it's that eventually they pop. Now, this isn't about being negative, not at all. It's about being a realist and looking for where the real sustainable value might be hiding.
And that, right there, leads us to the billion-dollar question. If AI stocks are the big, flashy fireworks show that has everyone's attention, where is the smart money quietly setting up for the next act? What are they buying up while everyone else is just looking up at the sky? Well, that's exactly the map we're going to lay out for you right now. We're going to follow a really clear roadmap today. First, we'll look beyond the bubble. Then we'll walk through a professional framework called the top-down approach. After that, we'll break down a super important concept, sector rotation. That's going to lead us right into the spotlight on 3 specific defensive sectors that are showing some real signs of strength. And to wrap it all up, we'll talk about how you can find the best companies inside those sectors. You see, to find the real opportunities, we have to get away from that chaotic chase. We need a calm, strategic approach. And that means using a professional framework to filter out all that market noise and see where the capital is actually flowing. This is all about building a process that you can use again and again, not just gambling on hot stock tips. So the core of that professional process is something called the top-down approach. Now, instead of starting small with just one company and trying to guess its future, you start with the biggest picture you can imagine, the entire market, and you work your way down. Think of it like using a set of sieves, each one finer than the last to find the little nuggets of gold. And this slide right here lays out that 3-step funnel perfectly. First, you analyze the whole market. Think the S&P 500, just to get your bearings. Are we in a bull market, a bear market? What's the general vibe? Second, and this is so key, you break the market into its 11 sectors and you rank them. This immediately shows you the strongest neighborhoods to be investing in and, just as important, the weakest ones to stay away from. Finally, and only after you've found a strong sector, do you zoom in to find the best companies. This whole systematic funnel, well, it's your shield against making decisions based purely on hype. All right, now we get to the engine that makes this entire approach work, sector rotation. This is the mechanism that lets us see how the smart money is positioning itself for what's next. It's kind of like following the footprints of the biggest investors in the world. So what is it exactly? Well, put simply, sector rotation is just the large-scale movement of money from one area of the economy to another. A great analogy is a farmer rotating crops, right? They don't plant corn in the same field over and over again because it just drains the soil. They rotate to keep things healthy for the long term. Well, institutional investors do the exact same thing with their money, moving it into sectors they think are best positioned for whatever's happening in the economy. Our job is to see where that money is flowing. This slide shows the market's fundamental balancing act. It's like a giant seesaw. On one side, you have the aggressive or cyclical sectors. We're talking tech, luxury goods, things that do great when the economy is booming. But when those big investors start to get nervous, they shift their weight. They rotate their money out of those high-flying stocks and onto the other side of the seesaw, the defensive sectors. These are the ones that provide stability and safety when things get choppy. So, if we apply that logic, where is that rotation happening right now? Well, the data is pointing to a classic shift towards caution. While everyone's chasing the potential future profits of AI, a lot of institutional money is flowing into sectors that secure guaranteed present cash flow. We're about to put a spotlight on the 3 that are really showing the most strength. Okay, our first defensive sector is consumer staples, which you can track with the ETF ticker symbol XLP. This is the sector of everyday stuff, the things people buy no matter what the economy is doing. I mean, think about it. In a recession, you might put off buying a new car, but you're still buying toothpaste, right? You're still buying toilet paper. That's the core idea behind consumer staples. These companies sell things people absolutely need, not just things they want. A company like Procter & Gamble isn't going to suddenly double its earnings because people don't just start brushing their teeth 4 times a day. But their revenue is incredibly reliable. They don't offer that explosive textile growth. Instead, they offer something way more valuable when things are uncertain: predictability. And that stability is exactly what makes them a safe harbor. Next up, we've got the healthcare sector. You can follow this one with the ETF ticker XLV. And just like with staples, the demand for healthcare is incredibly consistent. It's what we call non-cyclical. To put it simply, healthcare demand just doesn't really care about the economy. People need their medicine, they need treatments, no matter what the stock market is doing. And when you add in these powerful long-term tailwinds, like aging populations all over the world, you get a sector built on a foundation of steady growing demand. And that's not some short-term trend. We're talking about a multi-decade demographic shift. This reliability is exactly why it's another classic safe haven for big money during uncertain times. And our third and final defensive sector for today is utilities, with the ticker symbol XLU. This one is maybe the most classic safe harbor investment of them all. I mean, utilities provide the absolute bedrock of modern life: electricity, water, gas. Their cash flows are so stable and predictable because, well, people always pay their power bill. You don't invest in utilities for explosive growth, you invest for stability. And this is crucial for the reliable dividends, which can give you a nice steady income stream. They even have predictable seasonal kicks, like more natural gas being used in the winter, which just adds to that predictability. When the market is a storm, utilities are the lighthouse. So let's just put that all together real quick. We've got consumer staples, XLP, which is built on necessity. We have healthcare, XLV, driven by that non-cyclical long-term demand. And we've got utilities, XLU, providing those essential services and steady income. All three are classic defensive plays for when the market seems to be getting a little bit frothy. Okay, so we used the top-down approach, and we've identified some strong defensive sectors. But a sector is really just a basket of stocks, right? So the final and most critical step is to find the best of breed companies inside that strong sector. And to do that, we use another professional framework.
This four-pillar framework helps you inspect a company from every single angle. First up is fundamental analysis. This basically just asks, is this a good business? You look at its earnings, its debt, its competitive edge. This tells you what to buy. Second is technical analysis, which asks, is now a good time to buy? Here, we look at the chart to see if the stock is trending up, if buyers are in control. This tells you when to buy. Third, we have cash flow. This answers, how can this investment actually pay me? Maybe through reliable dividends, for example. And finally, the most critical pillar of all, risk management. This is where you ask yourself, how much am I willing to lose if I'm wrong? And you set your exit plan before you ever get into the trade. A solid company at the right time with a payment plan and a safety net, that's the whole goal.
You see, when you put all of these pieces together, the top-down approach, understanding sector rotation, and then analyzing companies through these four pillars, you're not just guessing or chasing hype anymore. You are building a repeatable, logical process. You are building your own personal investment blueprint. It's your strategic plan for how you can approach the market with clarity and with confidence. So this entire framework, it's really about giving you a map. It's about shifting your mindset from being a passive consumer of all the market headlines to being an active analyst of the market's structure. You now have the tools to look past all that noise and find where value might actually be hiding. So the only real question left is, what are you going to build with it? What will your blueprint look like?